This time it's different because this time it's a period of high inflation. That's very different than a period of low inflation. And so everything that worked during the bubble is not going to work this time.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
Bitcoin is not acting like gold. Bitcoin was not able to hold the 30,000 level. I know when it first got above 30,000, all the Bitcoin holders were out in force. They got their laser beams up again, looking for 100,000 Bitcoin or higher. I mean, there's this one guy, supposedly, I forget who he was, that made some big bet that Bitcoin was going to hit $1 million like in a month or some short time frame. And it made a lot of news. Now, maybe he made that bet because he wanted to help push up the price of Bitcoin so he can unload a bunch of it and make a lot more money than what he threw away on that bet, which may have been simply a publicity stunt to try to generate some FOMO buying into Bitcoin from people who actually thought it was possible that Bitcoin could actually get to $1 million of Bitcoin, in that short of time period. So we've pulled back quite a bit, and potentially we've seen a high, not only in Bitcoin, but a lot of these risk assets. I mean, what happened to Tesla today and that 10% drop, to me looks like maybe we finally run out of room for these risk assets to rally. The reason they rallied so much was the market really got ahead of itself and looking forward at rate cuts, right? Well, because the Fed is going to be cutting rates because the economy is going into recession, and everybody just expects that recession means lower inflation. And so everybody was trying to get prepared for the next round of rate cuts and QE, thinking that the tech stocks would be the place to be because they were the place to be the last time the Fed cut rates to zero and went back to QE. Well, I've been saying that this time it's different. It's not going to be what worked last time that's going to work this time, because this time it's a period of high inflation. That's very different than a period of low inflation. And so everything that worked during the bubble is not going to work this time. So you have to have a completely different portfolio than the one that worked for QE 1, 2, 3, and 4. This time, it's going to be the value stocks, the non-U.S. dollar denominated stocks, emerging markets, commodities, gold, silver, those type of portfolios. Cathie Wood doesn't own any of these stocks. Her portfolio is the opposite of what you'd want to own for the economic environment. There's been plenty of attempts to hammer the gold price down. It was down, I think it was maybe on Tuesday, where it was down $30 or so on the open, but pretty much they've been selling off the price of gold every morning. It's been hammered back below 2,000. But as I've been saying, it's not getting too far below. Maybe 1990, 1980s in that area. But anything below 2,000 is bringing in new buyers. And gold is at 2004. So they've bashed it down below 2,000 several times. They may try a few more times to try to flush some people out. But the problem is more money continues to come into the market. Now, that's not a problem if you're long and you're expecting higher prices. But if you're hoping the price of gold is going to go down, or you're wanting the price to go down, it ain't working. Gold's not going down because too much money is coming into the market. There's a lot of money on the sidelines, a lot of cash out there that wants to move into gold. There are a lot of countries now around the world that have a lot of dollars that they don't want. They are trying to prepare for a post-dollarized world where the dollar is no longer the epicenter of the global monetary system. And so they have a lot of dollars that they don't need. Why don't they need them? Because we don't make products that they want to buy. We have a $1 trillion per year trade deficit. So that's $1 trillion that the world has every year that they don't really need. Now, while the dollar is the reserve currency, well, they'll hold on to those dollars. They'll buy U.S. treasuries. They'll buy mortgage-backed securities. But if the dollar isn't the reserve currency, if they don't need dollars to buy oil anymore or other commodities because nations are now de-dollarizing and setting up mechanisms for bilateral trade in other currencies, then what is everybody going to do with these dollars? Get rid of them. And what are you going to do with the proceeds of the sale? I think most sellers of dollars would rather own gold than just pick another random fiat currency like the euro or the yen or the pound or something like that. I mean, just look at a chart of the price of gold. Gold is in a bull market in every single currency on the planet. So whatever currency you're looking at, if you compare it to gold, gold is still better. And interest rates everywhere around the world, despite the fact that they've gone up, pretty much every country has interest rates lower than the inflation rate. So every country is offering negative interest rates. Well, how does that compete with gold? When countries were offering positive interest rates, that was competition for gold because gold had no interest. And so governments, in effect, said, hey, don't hold gold. You're going to lose out on the opportunity to collect all this interest. Hold pound sterling, hold the euro, hold the dollar, right? All these currencies, the central banks were giving people an incentive to hold them. Now they're providing the opposite. They're incentivizing everybody to buy gold. If you hold British pounds, you are going to lose purchasing power. The inflation rate is well above the interest rate. So we're not going to pay you anywhere near enough interest to offset what you're going to lose to inflation. So what's your alternative? Buy gold. Everybody is now being incentivized to own gold instead of fiat currency to avoid that loss. You see, gold is now a higher yielding asset than any of these currencies. Not that it has a higher positive yield, it just doesn't have as big a negative yield because gold has got a 0% interest rate and all these other countries have a negative interest rate that's much larger than that. Even if you factor in the cost of storing your gold and figure, okay, so it's 15 basis points a year, so I've got a negative yield of 0.15, that's still a higher yield than any of these currencies. So that's what's going on. Central banks around the world are divesting and they are building up their gold reserves. And that's why you don't have a lot of downside risk in the price of gold. There's too many buyers beneath the market looking to buy, and they will take advantage of any opportunity. That's why the opportunities are not going to get that big. So if you're looking to buy a dip, you may get a small dip, but you're not going to get a big dip. So you have to just step up and buy because the people who are too greedy, who are waiting for too big a sale, are going to be left out in the cold, and they're not going to end up with any gold, and they're just going to watch the price skyrocket. So I'd be buying now. And again, the same thing with the mining stocks. The mining stocks have pulled back a little bit. With gold keeps getting hammered, it doesn't crack. But these gold mining stocks are correcting now, even though the price of gold is really not. Yes, it's off its high. Gold got to like 2040. So we're off the high. But the fact that we keep closing above $2,000 an ounce, to me, represents significant strength that you're getting buying at this number. You're not getting a rush to sell. You're getting a lot of people coming in to buy because they know that 2,000 isn't expensive, 2,000 is cheap. So again, you want to buy your gold. I've been pounding the table. Call up the guys at Schiff Gold, buy gold. You want to be more aggressive, buy silver. Of course, they're not mutually exclusive. You can buy both. But if you want to get really aggressive and go for the home run and get the 10 baggers or more, you want to look at the mining stocks. You want to look at the Euro-Pacific Gold Fund. You want to talk to our representatives there about buying that fund or about setting up a managed account where you have individual mining stocks. I think this is where the biggest potential is. Instead of, following Cathie Wood and buying Tesla because you think that thing is going to be a 10 bagger, I think you have a much better chance of making that type of return with a gold mining stock and a lot less downside risk. The big money has already been made in Tesla. Maybe Cathie Wood hasn't noticed that, right? So where the big money is yet to be made is in these mining stocks because these mining stocks are much lower than they were 10 years ago, 15 years ago, whereas Tesla has already gone up dramatically. And so that stock should be sold. And a lot of these mining stocks should be bought. There may be a time in the future when Tesla's a buy, but this ain't that time. There's still a lot more downside risk in that stock.